Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes.
Good morning and afternoon, everybody. Thank you for joining our call on the Middle East commodity impact. Obviously, it's a very dynamic situation. It's changing by the minute. What we're not going to do is give you our view on how or when the conflict comes to an end, because you'll have your own view. But we're going to focus on what we can say or quantify about the commodity impact and how this could depend on different outcomes. So today you're going to hear some quick comments from BMO's commodity analysts. So we've brought together analysts across energy, fertilizers, chemicals, metals and mining. So we have Randy Ollenberger on the oil and gas side, we have John McNulty on chemicals, we have Joel Jackson on fertilizers, and then myself, Helen Amos, and George Heppel on metals and mining. So at a very high level, what we've seen over the last 10 or so days is that the initial moves in the commodities have largely reflected the extent of supply side exposure of the commodities to the Middle East region. Okay, and generally speaking, that's been greatest in the oil and gas side and fertilizers. And then in the metals side, it's been commodities that have particularly high regional exposure, which we'll come on to later. So obviously, very big moves, and obviously the situation is very dynamic. Obviously today, what we're seeing is a little bit of a reversal in the risk off that we've had over the last week or so. But on that note, I'm going to hand over to Randy to kick us off on the oil and gas side.
Thanks for that, Helen. And we're all, watching the headlines and watching the media coverage of this event, and seeing a lot of volatility in the oil prices. It spiked up to close to 120 yesterday and settled back down in the low 90s. But the reality is that we step back. I mean, this is the biggest event for the oil market that we've had in decades, certainly back to 1990, if not longer. And so, the reaction of the oil market, when you think about it from that perspective, has been relatively muted in 2022 following the invasion of the Ukraine by Russia. Oil prices were certainly higher, and the supply impact there was much less. So this is significant. The market seems to be underestimating the significance, and is doing so on the basis of the ongoing, I guess, perspectives that we keep hearing out of the U.S. government that is going to be ended shortly. It's not going to be ended shortly. Whatever the Iranians are saying, most recently they're saying that a liter of oil is going to move through the Gulf. But the bottom line here is there has been a significant disruption. It has changed the fundamentals of the oil market very significantly. Even if this conflict ended tomorrow, we have changed the fundamentals of the oil market significantly. The narrative that we had coming into this year about oversupply is certainly gone and off the table. The longer this conflict goes, the tighter the market's going to get. Saudi Aramco on their call this morning said they are finally ramping up capacity and expect capacity on the East-West pipeline in a matter of days. But what that does mean is they haven't been shipping at full capacity over the last week and a bit, and that's what's filling up their storage tanks, and that's what's causing them to dial back production. And we've seen other countries, of course, dial back production in order to reach or not to reach tank tops. So all of this is having an impact on the physical market as well. We've got a lot of tankers that are stranded. It takes time to reposition. And at the same time, inventories in consuming countries are moving lower. So as I said, the fundamentals are shifting here. Where we end up at the end of the day in terms of the oil price is going to depend on the duration. It's going to depend on Iran's capabilities. And at that point, or at this point, really, it's just not predictable. We don't know those things. We don't know the U.S.'s intentions. We don't know whether they're going to just do one last significant bombing and then turn it over to the Iranian people to see if they make a stand and overthrow the regime, or whether the U.S. is going to continue to drag this out. And by the same token, we don't know whether the Iranians actually have the capability to follow through on their threat to close the Strait of Hormuz. We don't know whether the Iranians, in its act of desperation, will start trying to strike oil facilities in Saudi Arabia and elsewhere. But that's all possibility, and that all means that the risk remains elevated, and the bias of that risk is to the upside. As I said, even if the conflict ends tomorrow, I don't think we're going back to the 60s. We are going back to a lower price, but certainly not in the 60s anymore, given the physical change in the market that we've seen today. And the other thing that I think is important is to focus here on is just the disruptions of refined petroleum products. That takes longer to fix. There's not a lot of clean product storage in the world. So those tanks are being drawn down. We've got refinery outages. That's going to have an impact on the oil market that lasts a little bit longer. And then obviously with Qatar and the LNG facility, they've said it's going to take a couple of weeks to turn that thing back on and ramp it back up. So there are a lot of physical disruptions here that are going to take some time. And so we're not coming out of this unscathed. And as I said, the risk at this point still remains to the upside. I can leave it there, Helen.
Thanks, Randy. And just to make sure that everyone's on the same page, like we're still not seeing any passage of ships via the strait at the moment. Is that right, Randy?
Yeah, I mean, there's a trickle of ships moving through. So instead of the regular 80 ships a day moving through the strait, I mean, there's been one or two. There's actually been a couple of Iranian tankers. Iran's tried to sneak a couple of out, but the reality is, no, we're not. We're effectively not seeing any go through.
Okay. Excellent. Thank you very much. So let's now move on to the chemical side. John, over to you for some quick comments.
Yeah, thanks very much, Helen. So yeah, look, we wanted to hit on the chemical sector because aside from the oil and gas industry, it's probably one of the most direct and indirect biggest exposures tied to the Iran conflict. So to start, we point out that the duration of the conflict definitely matters, but nevertheless, it's been a positive, and some of those positives are going to be very long lasting. So let's hit on some of those direct impacts. So the most notable chemical in the chemical industry that's been impacted by this is the polyethylene industry. And it's in part why we upgraded Dow and Lyondell as well as Westlake early last week. The Middle East alone accounts for about 15% of global polyethylene production. Why does this matter so much? Well, in general, polyethylene had been very soft over the last couple of years or so, and it continued to soften. We saw the supply-demand balance is kind of leveling around the high 70s to low 80s in terms of utilization rates. And we were slated to see actually more capacity coming on in 26, 27, and 28. So we've had a big change with all of that. If you take roughly the 80% utilization rates that the industry was at, take out about 13% of capacity tied to the Middle East that actually has to come through the Strait of Hormuz. And you're talking about utilization rates spiking into the 90s in terms of effective utilization rates. Equally important, you have a decent amount of Asian producers that are starting to see difficulty in getting raw materials, oil, naphtha, LPGs, etc. And so you've got them running at lower utilization rates as well. So in some of our expert discussions, we've talked about potentially losing high single-digit capacity out of Asia, in addition to that low to mid-teens out of the Middle East. This puts the industry roughly at 100% or higher utilization rates. That's before any demand impact. There likely will be some, but you're still at very, very tight levels. So what does that mean? We've already seen 10-cent hikes for March in the U.S. with potentially more to come. We've got another 10% or 10-cent nomination for April. Each one of those is about 20% or a 20% increase from the prices that we're currently seeing. So clearly some big nominations that are happening. We're also seeing pricing starting to push higher in Europe. We've seen a 7-cent push so far in talking to our companies, and there's more to come. And speaking with CMA, one of the industry consultants, they're basically saying this is covering more than the raw material moves. The industry is going to get real margins. And we think that continues for a while, just given the magnitude of how much capacity is coming out. You're basically going from almost trough conditions to peak or above peak, at least the peaks that we've seen conditions. A compounding benefit, especially for the U.S. chemical names, is the light heavy spread. With oil having run up as much as it has, and gas, especially U.S. gas, basically staying relatively stable, you're widening out that ethane advantage that the U.S. producers make. Finally, in speaking to some of the experts, the longer term impact of this, it may last a while. We did have the Middle East where they were going to be adding significant capacity, about 5% over the next few years. Looks like a lot of that has been delayed and will be delayed and stay kind of off the radar for a while until the chaos winds down. And that'll take far longer than just the strait opening up. The next biggest area of benefit is polypropylene. Middle East accounts for about 10% of global production there, which goes through the strait. The landscape for polypropylene was somewhat similar to polyethylene. You were running at even lower utilization rates, somewhere in the mid 70s on weak durables demand, as well as significant capacity coming on. But with this 9 to 10% having been taken out of the Middle Eastern markets, as well as Asian capacity also, again, running slower, we expect the utilization rates to move into the upper 80s. It's tightening up the market dramatically. Beyond polypropylene, there are a handful of other chemicals that we do pay attention to in this case that are impacted. MTBE is probably the biggest one. Middle East accounts for 12 to 15% of MTBE capacity. With that out of the market and with crude having pushed higher, you're seeing significant moves already in MTBE. We've seen pricing up high teens so far. That's putting it to record levels at this time in terms of the seasonality, and things are going to get dicier going forward as you start to enter the summer driving season and seeing that incremental demand pull. Other areas of focus in chemicals, sulfur is one. Sulfur tightness is going to help TiO2 pricing. Sulfur was tight before the Iran crisis, but with about 40% plus of global capacity for sulfur coming out of the Middle East, with that in short supply at this point, it's going to push pricing higher in terms of sulfur. What that does for the TiO2 industry is it forces the sulfate-based producers, the Chinese producers, to actually have to raise price. So there's a benefit there. And then the last area that we'd focus on is just on the helium front. Qatar is a major player in the global helium markets. They account for about 30% of global capacity, which has been taken down with the Ras Laffan LNG terminal having been taken down. So this is something that is going to be tight, and the demand environment is relatively stable for this. So it's tied to the semiconductor industry. It's tied to healthcare applications. So you won't see much in the way of demand destruction. You will see spot pricing move noticeably higher. This is going to be a benefit for names like Air Products and Linde. So with this dramatic turn, that we've seen, what does it mean for the stocks? To be honest, it's taking some from famine to feast. That would certainly be the polyethylene names. It's one of the reasons why we upgraded Lyondell, Dow, and Westlake early last week. It is going to help the TiO2 names, as we said. That's going to be Tronox and Chemours. And like we said, on the margin for helium, while it's not a big product for Air Products and Linde, given what may happen in the spot markets, where we're expecting to see potentially 30 to 50% price increases in the near future, it's going to be a benefit for the industrial gas names as well. So with that, maybe I'll turn it over to Joel Jackson. He can speak to the fertilizers and the impact that it's having there.
Thanks, John. Hi, everybody. Yeah, so obviously, as we all know, the Middle East has very large production export market share for fertilizer and for methanol. And so we've really seen an increase in nitrogen prices and a lot of pressure more on sulfur. If this ends quickly, we could see some snapback. But I agree with John that I think the more this goes on, the more all this will linger for the rest of 2026, especially for nitrogen. We did write in the early hours of this conflict that CF and Methanex would benefit the most, and other nitrogen producers as well. And that's largely played out. CF has done quite well on this. We've seen nitrogen prices up a lot, 30%. And perhaps if there's an off ramp to this war, we'll see CF and nitrogen prices come down. But even mid-cycle free cash flow support here is supporting this stock here. So let's talk about the commodities a bit. Crop prices aren't really doing anything, but obviously nitrogen price, like I said, up 30%, sulfur price up a little bit. Modest prices increase in potash and phosphate. In nitrogen, look, we know that 50% of urea exports are coming out of the Middle East, including Egypt, which relies on some Israeli gas. We know that Russia is the largest exporter of nitrogen, and the next 5 are basically Middle East countries. We've seen production is largely staying online in the Middle East, even in Egypt, but we've seen Qatar halt production. We've seen UAE today start talking about things. We've seen gas price in Europe double, right? Whereas Henry Hub has stayed $3. So the North American nitrogen advantage, producer advantage for names like CF and Nutrien is really outstanding right now. And we've even seen India, which is a large nitrogen importer, but also produces most of the nitrogen itself. It's had gas halted there too from producers like Qatar. And so we've seen production drop of its own domestic production in India now 30% in the last week. We've seen countries like Turkey now remove urea import duties to try to help out farmers there. So, I think it's just generally going to be a lot of lingering impacts here, even if the war was to end in some days from now. In phosphates, of course, a bunch of phosphates produced in Saudi Arabia and Jordan, a little bit from Israel. We've seen prices go up a little bit, but the major issue we've seen is really, as John alluded to, with sulfur. Half the world's sulfur is traversing the Middle East here. And phosphate was very unaffordable going into this. It's probably going to be the hardest to pass through more input costs like sulfur. One of the biggest producers of phosphate is OCP, right? Mosaic's main competitor. And we think half of its sulfur is coming from UAE and Qatar. And we'll have to see if they have to lower production, if sulfur problems persist. And so we wouldn't be surprised if phosphate prices rise a bit later rather than nitrogen, which rose right away as prices have to catch up to these higher feedstock costs. Potash has been very quiet. Yes, Israel and Jordan produce a lot of potash, but they don't really have a Strait of Hormuz issue. So we haven't really seen a lot of problems there. On the methanol side, we've seen methanol prices rise 5, 10, 15%, depending on geography. Obviously, with Brent going up, there's more affordability too for some of the downstream methanol derivatives. Iran and Saudi are 40% of exports for methanol. A lot of that goes to China. So, Methanex itself hasn't done so well the last 10 days because of some, it didn't have a great print, a great quarterly release last week. But, as things progress here and methanol prices stay high, we'd expect the stock to do fine. One just random question that we've actually gotten from several people is talking about the U.S. spring planting. So we know that a lot of people expect farmers to plant a little less corn this year, maybe a 3, 4, 5 million acre shift from corn to soybeans, which is a bit negative for my space on the margins, for my producers on the margins. But I've been asked a question several times, could the amount of U.S. corn planted this spring be reliant on the amount of nitrogen available? I.e., if nitrogen is short, people won't have nitrogen, they'll just plant other crops like soybeans. But I don't think that's true. A third of the nitrogen goes down in the fall. It was late February. Most of the nitrogen for the states was already forward deployed into the channel. I don't think there'll be a shortage of nitrogen in the states, but so I'll leave it there. I think we're going to go now to Helen and George Heppel, correct? Yes.
Thanks. Thank you very much, Joel. So I'll make some quick comments on the metals and mining side, and then I'll hand over to George on the battery and critical minerals. So as I said in the beginning, the two kind of ways we're thinking about the impact. So first is the micro near-term impact on supply of the metals, and then the second order broader impacts on the macro, so the demand for the metals, and then in turn maybe mining margins. So essentially, those commodities with the greatest supply exposure to the region have indeed seen relative outperformance since the conflict started. So that's aluminium, which has 9% share of global supply from Middle East. We also flagged iron ore. Now the region accounts for 13% of global pellet supply. A lot of that is consumed within the region, but a lot of it is also exported to markets like China and India as well. And also there's inflows of pellet feed via the straits into the region, and then outflows of pellets. So we think maybe iron ore has benefited a little bit as well. And then thermal coal obviously has been benefiting, not because of its supply exposure, but lifted up via higher gas prices. And then on the other hand, we've had relative underperformance in the metals where the downside risks on the macro side have just dominated. So downside risks from higher energy prices, new concerns over inflation or the rate cutting pathway, or US dollar strength. So that's copper, nickel, silver, and actually even gold has not been performing too well because of the US dollar strength. As said, the reversal that we've seen today on the back of the developments with the G7 potentially releasing strategic stocks, and then Trump's press conference last night has slightly altered the trade today, but there's still clearly a lot of uncertainty. So just before talking on the macro side, just to expand very briefly on the point for each of the main commodities. So aluminium, I'm sure you've seen a lot of commentary on the fact that so 9% of global supply, but of the almost 7 million tons of primary aluminium production from the region, as much as 5 million tons of that has already been subject to some sort of disruption. So we've had Qatar Energy's Catalan plant, which has been put on care and maintenance. We've had force majeure declared from Bahrain, and then also EGA talking about disruptions to its shipments. And then, so that's already quite a big part of the region that's potentially with supply at risk. And then, of course, we haven't even had Mosal, so South32's Mosal plant off stream, which I think is scheduled for 15th or 16th of March. So all up, it does seem that if the conflict continues, there's probably scope for the market to tighten from what I think is being priced in today. On the iron ore side, yes, I've mentioned the supply side exposure, but the other way that it's coming through in potentially some price support is the fact that when you've got higher energy prices, that causes steel makers to seek higher quality iron ore inputs because that reduces your energy consumption, be that through the DRI or EAF routes or through the blast furnace route. So that's probably adding a little bit of support to the cost curve via widening spreads along the cost curve at the moment. And let's not forget, there has also been in the background the NPC readout from China, which was probably a little bit on the positive side. On copper, I think it's fair to say it's quite exposed to risk off and like the macro risks that come with higher energy prices. But of course, we've had lots of questions on the impact of sulfur and sulfuric acid. So yes, there is a potential volume impact if there is sustained constraints in sulfur exports via the Strait. But also on like the relative positioning of assets along the cost curve. So if SXEW assets get hit more by higher sulfur prices than the concentrate smelting refining assets, that would naturally result in a little bit of reordering of your assets there. The thermal coal I've talked about, I would say that we were already flagging thermal coal as a commodity that was looking quite interesting even prior to this. It looked like the market was starting to tighten up and respond to the developments out of Indonesia with the big reduction in quotas that were announced for this year. And also I think it's been benefiting a little bit from anti-involution in China. And then finally, gold, we have had, I guess, a few questions about why it hasn't really popped higher on safe haven demand. And I think in this case, it's clearly been very tightly inversely correlated with the US dollar moves. So we are keeping an eye on ETF flows there and central bank demand, particularly because a lot of the ETF flows and central bank demand has been driven by emerging markets over the last few months and last couple of years. And emerging markets are like the big losers so far, really, unfortunately, with this, because they're very exposed to energy imports. And also they're at a stage of their development where their energy intensity and their oil intensity of economic output is still on an upward trend, whereas the developed world, the oil intensity is falling over time. So we would be very much keeping our, obviously we've seen some of the emerging market currencies really drop off since the start of the conflict, and that's really eroding their buying power for metals and particularly gold. I'm just going to say one or two quick comments on the macro side. Obviously, we're getting a lot of questions in terms of like, if we now move into a more protracted period of high energy prices, what does this mean for our thesis on metals and mining? We've obviously been quite constructive on the space. We do think that, before this, we were in the midst of this like multi-year mining upcycle with margin expansion ahead, lots of drivers there. Now, one thing I'll say is that, through all of this, you could argue that the event in itself has probably strengthened the medium-term thesis for pushing towards electrification and reducing dependence on energy, on fossil fuels. So all the activity that we've been seeing in various regions of the world, particularly in China, to reduce fossil fuel exposure and move towards electrification and renewables, that surely will be accelerated. And then, of course, the other thing that comes up is the fact that we were already seeing visible stockpiling in some parts of the world of metals and copper quite visibly. And, this surely will lend even more urgency towards that trend. The other thing is when we look at very long-term intensity of oil in the economy, really we're well on our way to, I would say, kind of decoupling between the use of oil in the economy and the use of copper. So where for several decades now, at least on a per capita basis, copper use is increasing as the global economy is becoming more electrified, whereas on a global basis, at least, the oil use per capita has kind of been flat. And obviously within that, we've got diverging trends between developed and emerging markets. And then really the other way you can look at that, which I think gets the point, is if you look at price performance, really, up until around 2021, copper and oil prices tended to be more often than not positively correlated. And that was because, they were both an indicator of the global economy, but also the copper price tended to be trending a bit closer to its cost curve. So it's a bit more sensitive to the cost side. Really, since 2021, the copper price has really decoupled from at least its operating cost curve. So, and then obviously both of those commodities have had different trends on the supply side, which we're all well aware of, like particularly underinvestment in mine supply. So really, since 2021, if anything, we've seen a stronger negative correlation between oil prices and copper. So that's just something to also bear in mind as we move through the conflict. Okay, I will now pass over to George.
Thanks, Helen. So I'm going to be talking about the impact on battery metals and critical minerals. I mean, first off, a few obvious points. Helen mentioned the heightened shift to renewables as a result of a sort of sustained disruption in Hormuz, and obviously that is it makes the economics of electrification and EVs and also ESS much better. So in a way, it could be seen as a sort of net positive for battery metals in the medium to long term if we do see sustained disruption to the Strait of Hormuz. But looking a bit more closer to home and looking a bit more in the short term, it's worth thinking a little bit about how it impacts lithium and nickel, especially in the here and now. Now, obviously, the two biggest input costs in the metal supply chain for a lot of base metals and battery metals are number one, acid, and number one, energy. So obviously the impacts that we're seeing to the oil price and to the sulfur price is having a big impact on the economics of those markets. But let's talk about lithium first. So on average, it takes about 1 ton of sulfur, or around 3 tons of sulfuric acid to make 1 ton of lithium carbonate. Now, sulfur is currently trading at about $550, $560 a ton in the Chinese market, as we've discussed. And of course, depending on who you speak to, the all-in sustaining cost of lithium carbonate is probably around $10,000 a ton, let's say. So if you do see an increase in the sulfur price, it's not necessarily going to push up lithium costs too dramatically, especially considering that price is trading significantly above the cost curve. So is an increase in sulfur prices going to push up lithium prices? I would say probably not. I think the key issue, though, is really, if we do see a sustained disruption, will be availability. China is the biggest importer of sulfur in the world, also the biggest refiner of lithium in the world, and it's principally used for making fertilizers and chemicals. Sulfur is used as a precursor for making caprolactam, which is used for making nylon, for example. If we do see sustained shortages of sulfur, and that disrupts lithium refining activity in China, then that's certainly something that could push the price up. However, we are a few weeks and a few months away from that. Current sulfur port inventories in China are around 1.7 million tons, according to data from CRU. Now, China imports about 750,000 tons a month of sulfur, so that's just over 2 months of stock. So, we're not likely to face sort of sustained shortages of sulfur in China yet. But if this disruption is sustained into the weeks and months length time frame, we would begin to see an impact. Nickel, on the other hand, I would say is a lot more exposed to the current situation for a couple of reasons. Firstly, nickel is significantly more sulfur intensive in terms of its extraction. So high pressure acid leach, or HPAL, is responsible for around 15% of global nickel supply out of Indonesia. Indonesian HPAL, 15% of global nickel supply, and it takes around 10 tons of sulfur per ton of nickel, because it's much more acid intensive, so much more heavily exposed to changes in the sulfur price. Sulfuric acid costs represent around half of the total costs of making MHP in Indonesia, and you also have to factor in that the nickel price is trading much closer to the marginal cost in Indonesia, which means that we are beginning to have a significant impact on nickel margins if the sulfur price does increase dramatically. So the other thing as well to consider as well is that Indonesian sulfur stocks are significantly lower than China. We don't have months and months of port stock buffer in Indonesia in the same way that we do in China. So if we do see a sustained shortage of sulfur, that could have a big impact on nickel production as early as, for example, next month, is what a few analysts have been suggesting. As early as next month, we could begin to see disruptions to nickel supply. What would that do to the nickel price? Well, the nickel market is one with very large overhanging stocks. So I'm hesitant to suggest that this is going to send the nickel price shooting for the moon. We do have very, very large stocks, especially on the LME of refined nickel, so it's not likely to result in immediate shortages of nickel if we do see curtailments in Indonesia, but it's certainly one to watch. So that covers battery metals, but obviously we also need to think a little bit about the impact on critical minerals. Now, Helen mentioned that the actions on the Strait of Hormuz and the ongoing war are likely to incentivize the stockpiling of materials and definitely sort of bring greater focus on, international stockpiles of materials. And I think critical minerals obviously feeds into that very well. Just thinking much more practically about how critical minerals are being used in this conflict. Trump is spending, by some estimates, $1 billion a day on this conflict, much of which will be on munitions and which will need to be restocked. And indeed, President Trump did post on Truth Social recently that he met with defense industry leaders who have pledged to quadruple the production of advanced weaponry, in parts to restock US military weapons inventories. So that's obviously going to feed into critical minerals demand. I think this war is also just a reminder of how metals and material intensive 21st century warfare can be compared to previous engagements, compared to what we saw in Iraq and Afghanistan. Modern warfare seems to be very much a numbers game. It's a question of vast numbers of cheap drones, ballistic missiles, cruise missiles, and having counter defenses which can take them down. It's very much a numbers game. It's about throwing as much at a defense system and seeing what gets through, and that is obviously significantly more metal intensive than the style of warfare that we've seen in the past. And that obviously puts a lot more pressure on critical minerals and military metal demand than we've had in the past. And none of it is recycled, obviously. It is gone forever, effectively. And I think there's a growing appreciation for the fact that Western ammunition stockpiles probably haven't been high enough to fight a kinetic war like this. So I wouldn't be surprised to see strong stockpiling demand. In terms of narrowing down on what are the critical minerals which this covers, well, we've talked a lot at BMO over the last year about in terms of which critical minerals we see as the most important. A few that I would just put a particular focus on. Firstly, tungsten. We've been banging the drum about tungsten for a few months now because it is a market in very critical shortage, and I would say I've seen estimates that around 10% of total tungsten consumption in the USA is just from the military. So it is a big driver of regional metal demand. Rare earths, obviously, antimony. I would also focus on because it's used quite frequently as a lead hardener in munitions as well. So that's something to keep an eye on. But it's not just the USA. Obviously, recent strikes in Iran are likely to reinforce government commitments to investing in defense more broadly, and that is likely to drive a wider critical minerals investment renaissance, and one it definitely means it's a topic to remain on focus. So to wrap up, for now we are a few months away from lithium production curtailment, maybe a few weeks away from nickel production curtailment. Sulfur tightness is likely to impact nickel margins, but on the critical mineral side, I think it's more that the events of the last 11 days have been a very sobering reminder for governments in the Middle East and further afar on just how important stockpiling and having a secure supply of those materials is. With that, I'll leave it there.
Thank you very much, George, and thank you to all the speakers.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.